You want a lazy portfolio you can set up within an hour, but also sleep at night. Today we're going to go through a lazy portfolio setup. Certainly if you're in the UK, this will be perfect for you. I'm going to go through all the tools, all the metrics, all the elements around risk management, and it will help you massively. I'll even go through higher risk sort of ETFs you can find, because some people have a little bit of a inside knowledge in a way of certain things around jobs. You may be interested to sit on them and forget about them as well. But I do run a stocks and shares ISA mainly for dividend portfolio, but I do have some ETFs within that, and I'm going to be adding more as we go. So by the end of this video, you should be pretty well established in terms of building your own wealth. Quick disclaimer, this is educational and not advice, but ultimately do your own research. Got it? Let's go. Now, for UK investors, on the screen, a stocks and shares ISA should be your first protocol. If you don't want that, you should be doing this in a SIP, technically, right? Because that is a pension, and there is other taxation benefits to that as well. Again, do your research. And lastly, general investing. That's where I think most people make the mistakes, because they're just doing a normal investing broker account and they're actually not getting any tax benefits from that. So keep it simple. They're the obvious. There is links below to Trading 212. There is links below to Invest Engine, which I will showcase in a bit. But ultimately, don't set up on the wrong foot, because if you cock it up at the first point, it's going to be a pain in the ass. Now, on the screen, as you can see, the recipe for simplicity, right? 80 to 90% of it should be very much simple. Following the market in the all world funds, the S&P, whatever. But more importantly, they're broad, they're cheaper to run, and they have diversification within it throughout many, many different stocks. Not to mention, some will also have a Great British Pound Hedge Global Bond Fund within that. Basically, you want the obvious and the best as your broad elements, and then the satellite, essentially, long story short, the random stuff, the tilt, the small emerging markets, the optional potential crypto ETNs and stuff like that, or blockchain funds and AI data centers. As I said, with that, it's maybe down to small allocation, but ultimately, if you've got a bit of an interest in that, you're not going to get yourself blown up with it for obvious reasons. So you've got to think of it in logical terms, certainly when it comes to risk management. Now, how to find them. And we're going to freestyle this a little bit and just go through some stuff and some very, very obvious things that you can do. And there's no real plan to this. But firstly, just ETF is the obvious in the room, right? Find ETFs. Boom. Hello. There they are, right? Simple as that. Now, I want to say something that people may not agree with. But if you look at the fund size, right? The fund size of how much monies is in things. That is a really good place to start, because if you're looking for popularity, you're going to see two things. One, a good fund. Two, a cheap fund. And three, a performing fund, because people will put their money in that. They're the most recommended. So on the screen already, on the overall situation around all of it, it's all divvied up in terms of what? Feel free to answer in the comments. Fund size. So the first one is the S&P 500. The second one is the All World Fund. The third one is another S&P 500, which is from Vanguard. Now, obviously, you've got different providers. That's fine. Different providers will do different management things. They'll also have different rates, and they'll also either be fully backed or physically backed, or certain ways of doing it, right? Do your research, whether you want BlackRock, Fidelity, Vanguard, whatever it may be. Do your own research. And if you're happy with whatever, go with it. Simple as that, right? So, as I've alluded to it, the obvious in the room is these. These are the big boy funds. These are the ones with most, obvious diversification. Now, obviously, yes, you can look at the All World Fund and the performance and the distribution of it. Now, obviously, accumulation is, I think, better for a fund, because it will add the dividends that it may or may not get into the fund automatically. You're not getting cash, and it will just gradually grow. Some people like distributing ones, which is fine, I get it, but ultimately that cash may be repurposed into other stocks, and it will potentially disrupt the compounding effect. But let's look at one more thing. Each fund will tell you what the gubbins are, right? Basically, long story short, as you can see here on this one, you've got 1,322 stocks on it. And you can see the overall performance, its tickers, its overall kind of inception date, all that kind of stuff. As I say, do your own research. But the reality is here, each fund will be different in certain ways. And as you can see here, the volatility is relatively all right, considering what it is. But more importantly, as I've said, you will see different things because this fund, the all world fund on that one, will be different to another one, because I know for a fact that this one here, the accumulation fund's got 3,500. This is the one that I actually have, right? So each one's different, and obviously you've got different sort of things. The reason why I've gone with this one is because there's a bigger diversification element to it. It's bigger, even though it's a little bit more expensive, but ultimately it's fine. But it is physical. Physical, I would say, is always the best one, because essentially what happens here is it showcases here, as you can see, a physical replicating the ETF tracked by buying the securities included in it. So they have to have them to do it. So it's up to you whether you like that or not. Some people don't, some people do. But more often than not, you can see certain things. But as I say, going back to this one here, yeah, it's fine. It's got a bigger fund. It's also physical too. But the fees are a little bit less, okay? But that is BlackRock. But as I say, you got less in there. So it's entirely up to you, of course, but that's just giving you a bit of an idea. Now, as I say, though, if you want to go down the rabbit hole, on the left-hand side here, you've got equities, you've got bonds, you've got commodities, precious metals, cryptocurrency, real estate, and money markets. Now, the money market is sometimes what people like to do, because essentially the money market is what's happening overnight, the return of the base rate. That can be quite a simplistic way of doing it. Again, we can talk about metals. We can talk about the likes of the gold ETFs, right? Gold is doing very, very well recently. You may be interested in gold, and as you can see here, you can buy into the gold one. So just to give you a bit of an idea here, but obviously, again, equities are the most obvious ones, but then again, you got the bond market as well. What is the bond market doing? And as you can see, the thing is, right, this market, realistically, long story short, is designed to make money at some way, shape, or form. You've just got to trust it and know what you're doing and understand what each fund's doing. But for the base obvious in the world, look at the biggest fund size, because that makes sense. But on the screen, as you can see here, a super simplistic way, a set and forget, super simple global equity fund. Why not? 80% of your wealth in that. You're diversified, you've got no issues, the fees are low. And then you've got 20% of global aggregate GDP hedge. But as I say, you can change this in many different ways, and you can have many different things. You can change that if you want to, certain things. Because, for example, what about if you change to that? For example, I'll show you where you can find these funds. But as you can see here, you can change it to a blockchain fund or emerging market fund. You don't have to go fully balls deep. But I'm just saying there's many different ways of doing it. Because when you go on just ETF as well, you can go on the markets, and the market will tell you what to do in terms of what sort of category. If you go to the market overview, realistically, you're going to find a whole lot of stuff. And this is where it gets a little bit crazy. And as you can see, yes, you're still looking at the obvious in the room at the top, the global indexes. But then you start looking down and you go into the best and the worst sectors, right? But you may be into a sector of whether it's your work or whatever, as I say, and you may find something that a bit of an edge because you've already got a little bit of an interest in it. But as I say, without being too mental, go to the emerging markets tab and you'll find a lot of stuff here, realistically in different countries, different sectors. But when you go even further and go to the best ETFs, you will find lots of different things here. And these will start tickling your fancy. And as I say, you just got to go down the rabbit hole and you find stuff. Because you will find stuff in here that is bloody mental. And you'd be like, oh, I like the look of that. But as I say, you can also look on Trading 212. Because on the likes of Trading 212, if you go into equity ETFs and you just scroll down here, you're going to start finding stuff. So for example here, Wisdom Tree's AI fund. You've got the crypto and blockchain innovation. For example, semiconductors. Just to give you a bit of an idea of what you can get. And it's entirely up to you, of course. But as I say, you may find something that tickles your fancy. You've got all kinds on here. Developed markets, for example, and property yield, which is a bit mental. If you're into that business, you might be interested. Future of defense. Obviously, you must do your research, find out all the gubbins about the fees and that. But there is individual niche ETFs that may tickle your fancy, which could be a much, much smaller percentage of your risk. But let's go into some risk management. So going back to stuff like this, right? The whole element around the set and forget strategy, so to speak, is more about having most of your money in the obvious, which is going to perform well, the biggest money, liquidity and stuff, and then having a smaller slice diversified into more companies within that sector. That kind of makes sense because position sizing is key. Too many people go all in on, say, the blockchain or emerging markets fund or AI semiconductors, whatever it may be, and get blown up because they are very volatile. You'll see on Just ETF how volatile they are. Rebalancing, you need to also rebalance at certain points, because at one obvious point is you may well find on the likes of trading 212, your funds popped off and it's gone bang. And it's like, yes, mint, I've made like 40%, for example. If you were in gold, for example, you're laughing. Press the rebalance button and just crystallize some of those profits and put them into other things. So my goal is, and if you watch my previous video, don't forget to subscribe, by the way, I'm talking about mine with blockchain. I'm going to go through it and I'll show you in a second. But the whole element is you do not want to sell the core part. You only trim off the satellite fund or the riskier elements, because that's where the risk is in your portfolio to grow even more. You've got to enable the fact that you will be taking some profit off that, because they will be cyclical. There will be narratives at play that will make them go further. But yeah, you don't want to be too crazy with it. And at the end of the day, even these smaller funds here, for example, are diversified because they've already got ETF stocks in that mold, i.e. they've got loads of stocks in it anyways, and they're going to grow over time. And, you know, the whole question is, and we all talk about it, what if we invested, like, say, 20 years ago in the S&P? How well? Really well. But then you think, what about AI? What about semiconductors? What about robotics? As I say, blockchain, whatever. You may be kicking yourself thinking, I wish I did something about that. Now, just to show you my portfolio, what I've done already, and if you watch my previous video about the crypto ETNs, I've set up already a new pie. And this pie has got one holding in it. But that one holding, guess what, boys and girls, has no money in it, because I'm not going to touch it yet. I will be adding the Bitcoin and the Ethereum ETN. This is my satellite portfolio. And within this one fund here, as well as it's doing, and it could go further, it's got a really good performance rate. But it also is basically a lot of top companies in and around the blockchain element managed by BlackRock. But you got Bitcoin miners, you've got, you know, cryptocurrency exchanges, you've got, you know, companies that specialize in cryptocurrency or cryptography. And it's one of those situations where there's a bit of normality in here, like PayPal, eToro, like markets, right? But there's a lot of companies right now that are buying Bitcoin for their balance sheet, and they're going to get added as we go. So even though it's not the best fund in the world, it's a relatively new fund, but it's a good hedge in my viewpoint. But as I said before, if you want to do your research, put in your kind of niche. And if you put in on just ETF, the best blockchains for, you know, blockchain ones, these are all the blockchain ones currently. Now, as I said before, I am looking to buy mainly in the bear market that's up and coming. But there's already quite a few choices. The fees are obviously a lot higher with these ones, but the risk is obviously much greater. But as you can see here, yeah, there's different elements around them. The one that I've gone for is obviously this one here. But if I go for this one here, the CoinShares version, which is a little bit different, you know, they're all different in certain ways. They have similar sort of holdings. But a lot of these ones actually, as daft as it is, have, you know, MetaPlanet, for example, is a new one. It's Japanese, but they've been buying a lot of Bitcoin. You've got Galaxy Digital, Coinbase, Iron, which is a big miner. You've obviously got the semiconductor side of it because of the mining side of it. MicroStrategy, for example, too. So just give you a bit of an idea. But that plan is for me. Whether you want to repeat that or not is up to you, but I am in the cryptocurrency industry, so I kind of know this industry pretty well, but I can also know and understand that there is volatility here. However, that volatility will be a lot less in buying the individual stocks itself. Plus, someone's managing it for you. Makes it easier. So, on the screen, you can see try our regular investing calculator. Guess what? Automation, regular. Set up your direct debits, let it go out, have a plan. That plan is, I'm going to invest this much per month, it's within my budget, and I want to do it for, say, 20 years, 25 years, on a core and also some satellite funds. Oh, perfect. Because we're going to go through some simplified returns here because it makes sense. As I say, you need to have an initial investment and a monthly sum, and also how long your period is. So if we're going to change this to, say, I don't know, 25 years, right? Ignore the numbers for now. And let's just say if you had a nest egg of, say, 25 grand, no, 2,500, sorry, you want to put in, start off with, but you also want to add, say, £500 per month. And I know for some people that's like, fucking how much? But I'm just humoring me. You can see how the returns will compound over time. And now with this fund here, it's a decent little fund. That is tracking large and mid-cap elements, right, around a lot of the market, basically. But again, you can do obviously the S&P if you so wish to. That will well, there may be some volatility in there, but ultimately it will give you a bit more. But as you can see, the invested amount versus the total return is very different. Now, I'm not trying to set you up to fail here, but I'm just saying that this is how markets work. They gradually go up over time, whether they are just the mechanics or inflation or whatever it may be, or the Ponzi scheme of the US dollar, they do well, right? But as I've alluded to it, there will be periods where you will need a rebalance. There will be periods where you will need to maybe take some out of your little satellite funds and then put them into the bigger funds for safety reasons and risk management purposes. So you always need to manage it in some degree. But if you just want to go all in on the S&P 500 or all in on the all world fund, there's nothing wrong with that. But as long as you're consistent and you're looking at the obvious in the room, as I say, right, you have to get involved and understand that it is a time thing. Being a lazy investor is great, but you also need to allow it to have time. There's a lot of people that message me on TikTok saying, but ETFs are great, but you need 25 years. And yeah, if you've got 25 years and you want to do it, go for it. On the screen here, you got the AI narratives, right? And this is the situation. But if I go into the themes here, right, and this is a little bit of a bonus tip, you can see here all the different themes around certain things: cloud technology, climate change, cybersecurity, right? Just fintech, future of food. All of these have got little mini ETFs in them, which is mad. So just give you an example, right? Let's have a little look at fintech. 4 ETFs on fintech randomly, right? So a lot of these are all, financial technology realistically. But ultimately, it just depends on you, as I say. Clean energy. There's 19 for clean energy. If you work in that industry, what, you may well have a little bit of an interest in it. But on the screen here, there's a link to Snowball, right? Snowball is a fantastic platform to track all your stuff. You can also figure out your overall portfolio goals in live situations. Now, if you're using funds, it may not be that good, but if you've got individual stocks, it will tell you roughly your goals in terms of passive income, or more importantly, your stock market portfolio, which is pretty good. But realistically, as you can see, the compound effect is pretty big. And this is my own portfolio. Realistically, it will gradually grow and grow as you put contributions in, as things compound, as things get reinvested. So there you go. It's quite straightforward. Just I think people need to know where to go with it and understand the thing of it. I think a lot of people will have to, I think anyways, wet your feet a little bit, dip your toes in and try and understand the markets with an obvious one, and then gradually diversify with risk, understanding how the markets work and where the research is, and not get too unsettled by the volatility. But at the end of the day, just keep it simple. Go for the obvious fund. Have 80 to 90% of your funds in that. It's doing the same thing. It will make you money over time. It will give you a small little kickback in dividends for accumulation funds. And then as I say, if you've made profit, move some of that profit into, say, I don't know, a semiconductor fund if you're interested in that, or cryptocurrency, blockchain, whatever it may be. But the main thing is grow it, fund it, feed it. Simple as that. Automatically, consistently, and it will grow. It's like a flower. Anyways, if you want more of these sort of videos, watch all these. They will help you with the basic beginner stuff. There's a lot of different things and options. See you later.